Hi, and welcome to our discussion today of Biden's tax proposals. I'm Dee Dee Jones with Money Mastery of Dee Dee and with Innovative Financial, here to help you get up to speed on some of the issues surrounding the tax proposal that's currently been promoted by Biden. Now, when we talk about tax proposals, the one thing I can guarantee you is whatever we discuss today will change if and when this ever gets signed into law. So our discussion today is talking about what might come into play and kind of gives us some insight into the thinking behind the design of the tax proposals. So as you know, taxes and tax planning is turned into such a misnomer. I don't know how we plan for something that changes as frequently and as rapidly as taxes do, but here we go. We have another tax plan in place, or proposed to be in place. And with every tax proposals, there are winners and losers. Now that sounds a bit judgmental. There's not good language. So forgive me if I'm using language that doesn't feel genuine to your ears. It's just a convenient way to talk about how these tax proposals might affect folks. So with that preamble, let's talk about some of the expanded credits and lowered tax rates that the vast majority of folks will be eligible for. Earned income tax credit. Now, this isn't going to affect a whole lot of folks, but they extended the age. It used to end at age 64. Now, working elders can be eligible for this, and they've tripled the available amount. It used to be just over $500, and now it's a little over $1,500. If you're not familiar with an earned income tax credit, it's designed to help workers at the very lowest income levels support their financial lives. It's not only a credit against taxes that they owe, but it's refundable. So if they don't even owe taxes, it's money that is provided to them. And it was originally designed for families with children and has since then been expanded to families that don't have children, the working poor, if you will. So all across that has been expanded, but particularly for older workers and workers that do not have children. So it's something, if you or somebody in your world might be eligible for that, keep an eye on it. So the expansion isn't permanent, but a little bit of history here. Anytime we've had a change to the earned income tax credit, it has become permanent eventually. Next thing to talk about is parents. So there's a couple of things that are going to affect parents with children. First of all, the child independent care tax credit would increase from $3,000 to $8,000 for one child, and for two children, it'd be going from $6,000 to $16,000. So huge increase. And basically, it's designed to reimburse working parents for the cost of childcare for their children, and the reimbursement rate is going to increase from 35% to 50%. And so a family with adjusted gross income, look at your taxes to figure that out, or check out one of my other videos. Or adjusted gross income of $125,000 or less will get credit worth 50% of their qualifying expenses. So that's huge. Just so you know, there's a phase out between $125,000 and $185,000 of AGI. It's going to track down from the 50% to the 20%. And it stays 20% for families with AGI from $185,000 to $400,000. So all the way up to that $400,000. We're going to hear a lot about that $400,000 today, so remember that. And then between $400,000 and $440,000, it's going to go from 20% to zero. So full phase out at that $440,000, there will be no more credit. So that's the child independent care tax credit. And then, not to be confused, is the child tax credit. So this is, you have kids, you're not necessarily paying for care, or you could be, you could actually be eligible for both of these. But with the most recent tax law that was passed, this was expanded. So we would expand it from $2,000 to $3,000 per child. And if that child is under 6 years old, it's $3,600 per year. For individuals up to $75,000, heads of household up to $112,000, and joint filers up to $150,000, they're eligible for that entire expanded credit. Now that credit's going to be issued starting monthly in July through the end of the year, and then whatever hasn't already been paid out that a family's eligible for will be dispersed with the 2021 tax filing. So that's that's really helpful. Another thing that's proposed in this tax bill is help for first-time home buyers. This is a credit we've seen come and go over the years. This time it's proposed with a maximum $15,000, and the potential buyer can't have owned or purchased a home within the past 3 years to be eligible for the full credit. But the credit is scheduled to begin at the beginning of the year. So if somebody bought their first home during this crazy real estate market that we have, they might be eligible for this. There's some stickier rules on this one. Participants cannot make more than 160% of the area median income, and the home's purchase price must be no more than 110% of the median purchase price of that area. So there'll be a lot of calculations around that. It'd be interesting to see how that's put into effect. So credit could be a game changer for folks who have been renters. And if people are struggling to get their down payment pulled together, this can help with that. And it's a good time to remember that tax law allows you to take $10,000 penalty-free out of a retirement account for your first-time home. Now, under that definition, you only have to have not owned a personal residence for 2 years to be considered a first-time home buyer. So interesting things for the early buyers of homes. Now, another proposed rule is property exchanges. We call them 1031 exchanges, where if you've got a property that's appreciated in value, it's used for business, it's investment, you can sell that and buy a similar investment property and postpone the taxation. That's current law. That's been around a long time. One proposal is to limit that deferred gain to $500,000. And most folks go, well, that kind of seems reasonable. But there are families or investors who have taken a lot of advantage of this. And this could tax them a great deal. But for more families with more moderate means, this exchange opportunity could be a boon. So if you are somebody who might have a gain bigger than that, timing, you might want to be selling that property and taking advantage of the current 1031 rules sooner rather than later. So, incentive for retirement accounts, totally different here. This is an interesting proposal that says rather than just deducting from your income the amount you're putting into your retirement account, let's give you a flat 26% credit. What this does is folks who are at tax brackets lower than 26, they get a bigger boost. Folks who are at higher than a 26% tax bracket, they get less of a benefit. In fact, higher earners might be inclined to look at a Roth IRA rather than a traditional IRA. But it really could help lower income workers, incentivize them to contribute to those retirement accounts, which would be great. Let's see, keep going down my list here. Affordable Care Act, there's changes around there. Basically, the rules that were put in place last year, they're proposing that they be extended, not expanded. So the extension of the Affordable Care Act subsidies, if you're getting a subsidy on your health insurance, would stay in place longer. You don't want me to start talking about the details because there's a whole bunch of them. But that would help a whole lot of folks. So real quickly, there's a huge swath of folks who will benefit from the tax proposals in Biden's tax plan. Some of the folks who might not be loving the idea of the tax plan are high earners. So one of the stated goals is to make sure that people at $400,000 household income and less are not affected. That means if someone's going to pay for this, it's going to be the higher earners. So folks earning more than $400,000 are likely to see increases. Right now, the proposal is to increase the highest tax bracket from 37% to 39.6%. We'll see what happens with that. There's a lot of pushback on these tax hikes. Appreciated stock. If you have appreciated stock and you pass under current law, there is a step up in basis. And that means that any taxes that might have been paid on that stock or that property while you were alive are avoided because folks who inherit get a new basis at the date of your death. Law has been around a long time, but there's issues around whether or not that's fair for folks. So we will see. So Wealthy investors may not love this. For households earning more than $1 million, Biden's proposing to tax long-term capital gains and dividends at their ordinary income tax rates of 39.6%, nearly double the top 20% tax rate on such income. Now, Biden's plan means that the top federal rate for the highest earners would rise from 23.8% to 43.3%, and when you factor in the 3.8% surtax. So that was complicated, but basically income over $1 million, the long-term capital gains preferential rate may disappear. So now here's the interesting stat. This change only applies to 0.3% of taxpayers, about 500,000 households. So not a very broad reaching, a very focused, but pretty substantial. Hedge funds. If you've heard about hedge funds getting preferential tax treatment, they're proposing getting rid of that. And I already talked about the real estate investors. And another one that I think we could all agree on is increasing funding for the IRS to improve enforcement. There's a lot of folks out there who aren't paying their fair share of taxes. We'd all like to see them pay their fair share, because we all pay our fair share, right? Let's get everybody on board. So those are the winners, the losers, the pluses, the minuses, and maybe you have questions about how this tax law might apply to you. And send us a question in the comments below, or reach out to us at Innovative Financial. We're happy to help you with that. Thanks for joining us today. This has been Dee Dee Jones with Money Mastery with Dee Dee. Thank you.